Welcome to The Riff, where writer and investor Byrne and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in. Hello. Can you hear me?
Yes, I can. All right.
Okay, great. Let's transition into Meta. What do we make of their open source strategy here?
Yeah, so on Meta, the funny thing is that it's been a lot easier to describe why they have a cost advantage. That they bought all this hardware in order to train models for targeting Reels, because if you think of what your Facebook feed was composed of historically, it was all of your immediate connections have had a bunch of interactions on Facebook, and Facebook needs to rank those and show you, of the 5,000 things that your friends have done over, since the last time you logged in, what are the 3 that we should show you at the top of the feed? And then with Reels, you just have a much larger search space of potential things to show someone. So it is a harder targeting problem, but they apparently solved it faster than they thought. So they had excess capacity and definitely put it to work. And then Meta has some really interesting advantages in terms of training models, where they just have more experience than just about anyone at reading plain text and then making some kind of judgment about it, whether it is should we put this on someone's feed or not, or should we hide this and make sure this person never actually sees this message that was directed to them, unless they really go looking for it. So they have a lot of experience on that kind of thing. I'm sure they have a lot of implicit training data. I don't know that they would want to repurpose all of their user data forever just to train models. That obviously gets tricky for them, but there's still enough data out there for them to train things. And then they also talked about doing some really interesting stuff, which was, I think, not necessarily a comparative advantage of them, but it was interesting to read about, because there has been this debate about data walls, and just once all of the publicly available data has been ingested into models, and once getting access to it means signing some kind of exclusive agreement, like what Reddit did, or maybe not an exclusive agreement, but like an agreement that makes it very expensive to get that incremental token. What happens then? And one of the proposed solutions is we can use synthetic data. So you generate data from an LLM, you use that to train the next LLM, and you just keep repeating that. And you can kind of go either way on that, where one view is, no, it's going to be garbage in, garbage out, but it'll actually get garbagier over time, because the output is going to use a subset of the tokens of the input, and it'll use some tokens more frequently, and we'll slowly train the models so that, you do enough generations of this and your LLM just repeats the word delve, and that's all it knows. But the way that you avoid that is you have some kind of real world check on the output before you feed it back in as input. And they found that they could actually do this pretty well with programming, where you describe a problem, you produce some code, or you produce code in one language and you say, okay, convert this Python program into Go, or convert this Go program into Python. And then you actually write tests for it and see if it passes the test, see if it actually runs. And then if anything fails, you just try again. And because the LLMs are somewhat random, you can luck into getting the right answer, and then you just keep training on that. So that was pretty promising, pretty interesting. And then you have the other question of, okay, how does Meta actually turn this into something valuable? And I think there is like a high level way that you can say betting on AI makes a ton of sense for them. And that is that the reason that large consumer-facing companies don't want to roll out some AI product to everybody all at once, like Google did not want to have only AI-generated search results for everybody, even though that would have looked pretty cool. The reason you don't want to do that all at once is that inference is expensive and displaying static content is relatively cheap. So you want to use inference when you think it benefits, and you don't when it doesn't. And Meta can actually make that decision. I don't know if they would actually do it this way, but they could theoretically make that decision pretty much one page view at a time. Like, someone opens up the app and you have some estimate that is based on something more deterministic. So it happens really quickly of saying, okay, this page view is worth X dollars if we just use our existing stock of ads, and it's worth 2X if we use our generative tools to create an ad customized just for this person. And as long as that gap is larger than the cost of inference, then it's positive contribution margin to just do it. So they can actually roll it out somewhat gracefully, or they can say, when we are fully at capacity, then we use generative AI to show users things very cautiously. And when we're not at capacity, when we have spare capacity, then the marginal cost of that inference is pretty low. So we can go ahead and do it. So they actually have just more flexibility for how they roll this out in ways that are not strictly user face, like ways where the users don't realize they're interacting with AI, but they in fact are. So that part makes sense. But then how you go from that to, okay, Meta spent a couple $100 million training this wonderful open source model. Now anybody, or open weight model, now anybody can use it. And, hopefully the broader set of open source developers finds a bunch of cost optimizations that Meta couldn't. And so it's cheaper for Meta to use it. I mean, that's true. They do probably capture a disproportionate amount of the gains from that, but I don't think they capture the majority of the gains from that. And it's not entirely clear to me that as the cost of models goes up, that, I don't think Meta can use quite the same kind of thinking if the budget for the next model is, say, $5 billion instead. So it's still a little uncertain. I remain mostly optimistic that Meta is very well positioned to use AI internally and to develop it judiciously. And they actually, I think it was just over the weekend, or even, pretty in the last few days, there was a story about Meta buying voice rights to celebrities. And what I thought was interesting about that was that the natural way for Meta to use text generation and text to voice is there are lots of micro celebrities who are just famous enough that they can't interact one-on-one with every fan, but fans might enjoy the feeling of sort of interacting with this person. So you create an AI clone, people talk to the AI clone. It's great. Ballerina Farms is very busy churning butter and, gathering eggs from the hens or whatever. So she does not have time to have a Skype chat with you, but you could interact with an avatar of her. And, maybe that's sponsored by KitchenAid or something. She does use a KitchenAid mixer. So it's legit product placement. But when you think about doing that, you again have this cost problem of, okay, are we going to train a model that can replicate the voice and behavior of every single celebrity who has more than, say, 20,000 fans on Facebook? Probably not. But what we can do is we can take someone who already has name recognition, just buy the rights to the name, train a handful of models, train them well, maybe invest different amount, do different levels of training for different models. So you can see, okay, how sensitive are users to these different quality trade-offs, and at what point is it no longer worth it? And then once you've done that, you can at least see, okay, do people actually like the idea of interacting with these digitized celebrities, or is that just a pointless gimmick? And you've spent a few $1 million on voice rights, but you have probably saved multiples of that on your hardware cost. And so it probably nets out to a win.
Yeah. Speaking of these voices, Character.AI, of course, got acquired, or sort of, this new kind of acquisition or acquihire by Google. You think it's not just a way to skirt sort of the antitrust? Talk about what's happening here, similar to what happened with Inflection and Adept, and is this a new model, and why?
Yeah. So on the antitrust thing, I try to, what I think is like the right attitude is, whether or not it is explicitly meant to circumvent restrictions on acquiring your competitors, we will almost certainly never have a smoking gun, because any conversation of that nature does not happen over email. It doesn't happen over over the office Slack. It happens in person, or it happens on Signal. It happens in some medium where documents are not retained. Perhaps eventually someone will get in serious trouble for that. But for now, it's just those media, like encrypted chats that automatically delete things after a certain period of time. They are in practice a verbal medium, and this is the kind of thing people would discuss verbally but never write down. And I tend not to believe in claims that someone perfectly replicated the underlying substance of some transaction that's banned, and then they found some way to describe it such that it's not banned. Like, this happens from time to time, especially in the tax space, but it happens a lot less in a space like antitrust, where there is a fair amount of discretion about who you go after and what you go after them for. And their antitrust people tend to not look kindly on something that is just transparently meant to evade some kind of check that they would otherwise apply, especially in a case where the transaction would not have been cleared if it had been a traditional merger. I think the other way to look at it, though, is, and this applies much more, well, I think it applies to a lot of these acquihires, is that if you're building an early AI company, and Character actually talks about this in their announcement, if you're building an early company, you may feel that you have to go full stack. That if you are trying to let people interact with text-based avatars of famous people, you probably have to build your own model, you have to do all of your own training, and then you deploy it, and then you collect data, and then you use that to train the next generation of models, and so on. But if it turns out that that is just a less powerful approach than spending more money and spending more time on building really, really good general purpose models, at some point you say, actually building these models is not our core competency, and we should have somebody else do it. And you can see that happen, that evolution happen in other industries that have gone from being fully vertically integrated to the former integrated players are now basically systems integrators. So this is true of like a lot of the automotive sector, is that early on, if GM wants a steering wheel, they have to build a steering wheel. But eventually there's a whole ecosystem of people who build all of these components. And GM's job is some combination of build a handful of proprietary things that nobody else can get right, or that GM has some valuable patents on and uses their competitive advantage, and then buy a lot of other stuff from their suppliers and just assemble it and then market it and sell it. And so if you're going through that transition and you're an AI company, there comes a point where you realize that you have way too much hardware and way too many researchers, and they're like, both of those are very, very expensive to have, and you just don't need them. You just don't have a credible economic case. And what you probably have is something like 10 or 20% of the staff of a leading lab. So you could, if you wanted, always be a generation behind the models that those labs are creating, and you'd be spending a ton of money on that. Or you could just do API calls, you could just use Llama, there are a lot of ways to cut that cost. And then at that point, what do you do with all of the now excess assets you have? Well, probably those excess assets have already been getting a lot of pings from senior people at big tech companies asking them, just let me know if you ever have even like the slightest inkling that Character is not the thing you want to work on for the rest of your life, and we'll take you back. So I think that's roughly what happened, and I think we should probably expect that kind of thing to happen. You should also strongly expect that even if the initial discussion was we need to acquire Character, but we know the FTC won't let us, that the way that discussion actually did get translated into an email that was sent by someone who's using their work computer and sending it to a work email address, that it probably mostly focuses on that kind of economic situation rather than that Google really wants the talent and an acquisition is the best way to get it, but you have to structure that acquisition so you can actually make it happen.
Hey everybody, Erik here with a word from our sponsors. Fast forward to the end of 2024. Think about your goals. What can you do right now to give yourself the best chance of succeeding? If learning a new language is on your list, you absolutely need to check out Babbel. Babbel offers a range of learning tools, self-study app lessons, live classes, and even podcasts, which have always been my favorite way to learn. Studies from Yale, Michigan State University, and others continue to prove Babbel is better. One study found that using Babbel for 15 hours is equivalent to a full semester at college. Babbel isn't just a game to kill time and make you feel like you're learning a language. It's not overly academic or rigid either. It's all about learning language for the real world. Babbel stands out because it's designed by real people using a modern conversational teaching approach. It's not always easy, nothing worth doing ever is, but it's straightforward and designed to help you start speaking in just 3 weeks. With Babbel, I was able to brush up on my intermediate Spanish to ramp up for travel to Argentina last year, and was able to set clear goals based on how much time each week I wanted to practice. Join millions of Babbel language learners across all age groups. Here's a special limited time offer for our listeners. Right now, get up to 60% off your Babbel subscription, but only for our listeners, at babbel.com/zen. Get up to 60% off at babbel.com/zen, spelled BABBEL.com/zen. Rules and restrictions may apply.
I want to switch to search and particularly talk about what Reddit did and what that means for the broader search space.
Yeah, so a while back, Reddit signed a deal with Google where they said that Google does get to use Reddit data to train its AI tools and that other people don't unless they pay. And then it turned out that other non-Google search engines were not indexing the most recent Reddit content, and that Reddit was actually disallowing other search engines. And one reason for that was that there is like this quasi-regulatory arbitrage. It's not quite a regulation, but close, that you could have a bot that was ostensibly powering your search engine and just indexing pages so that they show up in Bing, but it's also grabbing the contents of those pages and feeding those to say, OpenAI. or to an internal Microsoft product or something like that. And Reddit just clearly saw that the economics of letting people freely access all of the text of your site have completely changed. That it used to be that if you do that, you are losing some traffic because people will search for something and Google will just populate the answer with some answer from Reddit. You don't have to click on the Reddit link, so they lose the ad impressions. But also, if Reddit is the top result for a lot of searches, and some of those searches are just longer than Google can summarize, or Google doesn't summarize it well, or the user just wants more information, then they will click through, so you will get traffic. So that's been the trade for a long time, is you let search engines review all of your content and occasionally summarize it. They occasionally take traffic from you, but they also provide you with more traffic in return. But now it's more like if you let someone view your content, you're contributing to some asset like some data asset that they have that is over time going to be a better and better substitute for your site. And that's always been a dynamic that search dependent companies have had to navigate. So Yelp complained about this a lot. TripAdvisor complained about this a lot, that Google was using their content to display results within the Google search page that could not have existed without the data from Yelp or TripAdvisor, and that led to clicks that did not give Yelp or TripAdvisor any credit. Ironically, one of the solutions to that is just for Google to buy Yelp or buy TripAdvisor and just say, we're going to subsidize this business. It doesn't really have to make money because we care more about the money we make from the data than the money we make from a plumber buying ads on Yelp, and that will also eventually sell that plumber ads on Google Maps instead. So that would have been a more elegant solution, but was probably just not going to happen due to both bad blood between those companies and the regulatory situation. So yeah, next best option is that the companies that own the data get slowly squeezed. The search engines slowly give richer results to users that are more monetized by the search engine than by the provider of the data behind those results. But that's just accelerated a lot through AI, and it has reached the point where it's just a tougher decision to give people free access to content you create.
That's well argued. Let's segue to what's happening with the Strategic Petroleum Reserve, or why managing that means betting against oil volatility. Can you talk about that?
Yeah. So there was a recent piece, and we find out who published it because it was really, really good. But it was a recent piece on managing the Strategic Petroleum Reserve more aggressively. So it's on statecraft.pub, which is good. And what the claim was, okay, we have all these caverns. We can pump oil into them and we can pump oil out. We tend to fill up the SPR and then just kind of have it sit there, which I think it is more strategic to do that. Like I think the original idea of the SPR was if we literally can't import enough oil, and if the US military actually needs oil to fix that, then you want to have a backup supply. But it's also an interesting macroeconomic stabilizer because, of course, you can accumulate oil when it's cheap, and that ends up pushing up energy prices and reducing inflation. And then you can sell oil when it's expensive, and that's typically when inflation is high, and you can be a little bit deflationary and just slightly mitigate the cost of these commodity swings. But if you think about that strategy of, okay, when oil goes down, we're going to buy it, and then when oil goes up, we're going to sell it. What you're always betting on is that that strategy works really, really well if oil bounces around some narrow range. And if every time it gets to the low point where you're buying, it immediately bounces up. And every time it gets to the high point where you're selling, it comes down. That strategy works really, really well. But that strategy also works really, really badly if you have completely filled the SPR with oil at 40 and then it drops to 20, or you've completely emptied the SPR with oil at 125 and then it goes to 200. And so it is also a strategy where it is basically the hedging side of an options trade, where if you are doing that, you are essentially capturing an income stream similar to the stream you'd capture if you just sold put options and sold call options continuously. And like with that strategy, that works really, really well if prices bounce around a little bit more than is reasonable. So you are always buying from someone who's being a little crazy to sell there and selling to someone who's a little bit off in their analysis when they're buying there. But if prices go really crazy, then your strategy loses a lot. But here's where the cool hedge comes in. So the SPR's parent company has a pretty substantial balance sheet. The US can print arbitrary dollars, so we don't actually run out of money to buy oil. And that always scares people, that the US can just create more money to fund government spending. But in this case, it means they're creating more money in order to fund spending on cheap energy, or cheap barrels of oil. And so the money creation is probably offsetting credit destruction elsewhere in the economy. So it's probably the good kind of inflation where you don't want a deflationary collapse, and this is one way to mitigate it. And then in the other direction, you could say, okay, well, the US can't just create an infinite amount of oil, but actually the US, it's not an infinite amount of oil, but the US can choose to relax restrictions on where companies drill. It can also just encourage oil exports in other ways. The US does actually have some flexibility to affect the global supply of oil, at least for now. Eventually, all the trivially frackable or relatively easily frackable stuff will be exhausted, and things will get a little bit less supply elastic than they were before. But for now, the U.S. actually has some control over just the global supply elasticity of oil, and that does make us unusually well positioned to run a short vol strategy, just betting that oil prices don't go too crazy in either direction, because if they go sufficiently crazy, the U.S. actually has a lot of economic levers to change that.
Yeah. Segue a little bit. Why did Andrew Left get in trouble for his activist shorting?
Yeah, so there are a couple pieces of that. One is that, so Andrew Left has had a long career of publicly identifying companies that are generally engaged in some kind of shady behavior. He will short the stock, announce what the company has done, and then typically cover. And I think that general sketch of the model has been widely understood. He's also sometimes talked up stocks, but I think usually to less effect. That part of the model is well understood. And one of the questions in that model, I guess two of the questions in that model are, one, is it actually Andrew Left doing this on his own, or is he doing this in partnership with somebody else? There was actually a settlement a couple weeks ago with a hedge fund that had been pitching him ideas and then splitting profits from short sales where he had written a report that pushed the stock down. So he wasn't doing quite what he said. He also did represent himself as running a fund with outside money, but I think the general assumption most people had was it's probably just his money, and that a lot of people do that. For a lot of people, I'm a hedge fund manager just sounds a lot cooler than I'm an unemployed person, but I have a lot of money in a brokerage account and trade pretty actively. Those are, for some purposes, roughly the same thing. Where it does get more complicated is that he would sometimes publish on a company, put a very, very low price target on the stock, and then immediately cover most or all of his short position as soon as the stock price moved, even if it didn't get anywhere near his price target. So, Left finds a stock trading at 10. He thinks it's a scam. He puts out a report saying this is a scam, price target $1, and then the stock goes down to 7, and he covers everything at 7. That is bad. And what is worse is doing that and then denying that he had covered his short position. So at that point, it does become someone talking down stocks and making misleading or, actually incorrect claims about his own behavior, his own trading behavior. And he's, in that case, trading against people who are in the market because they're listening to his advice. So creates a lot of conflicts, but it also raises this question. Okay, if Left had a short position and he talked about how terrible this company is, and then he covered his short position, what's his economic interest in claiming that he's still short? And the answer is, of course, that his short reports are a lot more effective if the stock price goes down and keeps going down. And Matt Levine actually pointed out in Money Stuff that some of the companies that the SEC complained about, where he did say this company is a fraud and the stock is going down, not only did it go below the price target that he set, but it also, in at least one case, there was an SEC investigation of the company that did claim that their accounting was dubious. So he actually got a lot of the factual stuff right and was a good guide to which companies were fraudulent and which companies were not. Where he was actually breaking rules was in claiming that he still had a short position when he didn't. But one reason to do that is that you actually want the people who shorted the stock, even though they were selling to you because you're buying back your short position, you still want them to make money so that they will short the next stock that you announce. So the economics of this were not as straightforwardly manipulative. He was sort of lying to people in order to improve their own financial performance because he knew that would improve his performance in the future. But still, it's the kind of thing where it is just a whole lot easier to straightforwardly disclose all of this stuff. And I think so the market impact of what he did would have probably been smaller if he had said, my business is identifying companies that I think are going down and then profiting from the immediate move that they make. I'm not in the business of managing a long-term short book. You could even go into detail on this. You could say there are large hedge funds that have great relationships with their prime brokers. If there's a question of who gets to borrow this stock in order to keep their short position when there are very few shortable shares left, the answer is almost always this other hedge fund and not me. Therefore, I'm not going to do this because I don't specialize in this, and somebody else is going to make that money. He could have said that. I think that would have meant that the immediate market impact of his announcements would have been a little bit muted. Like, people would know that when they short, Andrew Left is one of the buyers who is buying from them. But also, he would have avoided this. So I guess it actually comes down to a discount rates question. If you feel like your ability to spot shortable stocks is this depreciating asset, then you want to maximize the amount of money you get from it. And maybe you also just have higher risk tolerance for regulatory risks. And then if you actually want to be in this business for a very long time, and if you want to be remembered well when you leave the business, you do go a little bit more overboard on full disclosure. You recognize that you're actually giving up some of the near-term economics from doing that, but you also don't end up turning yourself into the SEC when they accuse you of market manipulation.
Coulda, woulda, shoulda. Good advice for Andrew Left. Let's segue into why public companies like issuing convertible bonds.
Yeah, this is a fun one. So the model that you should have for this is that if you're selling equity, you are monetizing the market's optimism about long-term growth of your business. If you are selling debt, you're monetizing the market's optimism about the stability of your business and about the value of whatever underlying assets you're using to build this business. And a lot of companies will structure their balance sheet in such a way that that's roughly what they do. So if the company owns buildings and factory equipment and things like that, where there is a resale value, you can figure out what the market value is. And also it just takes a lot of capital. They often fund a lot of that with debt. And then if they're doing something, if they have a different segment of the business that's doing research and development on some cool new product, they don't necessarily know whether that product comes out in a year or in a decade. And so you really don't want to borrow against it. You probably just end up not being able to pay back the loan, but you can issue equity, and then investors can kind of debate among themselves over how optimistic to be. And then convertibles occupy this weird middle ground where if you look at what a convertible bond is, you think, okay, it's just halfway between a bond and equity. So it is a bond. It pays an interest rate, although some of them do very low or 0% interest rates, but they do pay an interest rate. And then you can also convert that bond into a certain number of shares of stock at a certain price. So you think like it's a bond when things are not going well, and then it turns into a stock when things are going well. So maybe it's halfway between the two, but it actually monetizes something different, which is volatility, because the other way to describe a convertible bond is that it is a bond with a call option on the underlying stock attached. And that call option is worth more money if the stock is more volatile. So you can find cases where of those three things that a company can monetize, they can monetize the stability of part of their business, they can monetize the growth of their business, or they can monetize just the volatility of investor perceptions about that business. Sometimes the cheapest source of capital is monetizing that volatility. And if volatility is too high and you're selling it, then you are pushing volatility down a bit. So they are actually giving the market what it wants. But it is weird to think that is actually what they are selling, is not the stable upside of the business, not the questionable upside of the business, but just the uncertainty about what that upside actually might end up being.
Sticking here, let's talk about your piece of P&L beta. Why do most jobs not pay you directly for the slice of revenue that you generate?
Because the revenue you generate is very variable, and there are some tasks that you can do that do immediately produce measurable revenue and that aren't good for the long-term business. Like when I think about my own business, so I do the newsletter and I monetize that through subscriptions and through ads and through recruiting. So of those activities, probably the highest value per hour is recruiting, like talking to companies, talking to candidates. And then the lowest value per hour is actually researching and writing a post. And one way I know that is that I very, very rarely, but I do occasionally have to take a sick day or miss an issue, and it doesn't lead to any measurable change in subscribers. So people tend to assume that people don't work every single day all the time. And so they set their expectations based on that. But if I were to say, okay, given that I know the hourly return that I get from these different activities, I'm going to stop writing the newsletter and focus entirely on talking to prospective candidates. What I notice is probably in month 1, there's a lot more recruiting revenue. And then by month 3, there aren't very many new candidates and there aren't very many new companies. And then by a year from then, there's just no real business. So it is probably good for someone with a job like that to not have this compensation that's directly tied to their immediate P&L. You can think of that for other kinds of jobs. So in the piece, I gave the example of, suppose you're a software engineer and you're paid purely based on the revenue that is attributable to you. So here are the things that no longer make financial sense for you to do. Don't comment your code. Don't produce any kind of documentation. Never answer emails from anyone asking you what you're working on. Absolutely never train anyone junior on your team, but definitely feel free to pester people who know things that you don't know. Ask them for all the help you can. Like, all of these things would actually increase that software engineer's revenue contribution in the short term, and would eventually lead to a bunch of unmaintainable code that requires a lot of expenses that are harder to directly attribute to any one person, but you kind of know that those practices are responsible. So in cases like that, it is a lot more straightforward to tell people that you're getting a salary. It's typically a generous salary. You're also getting equity, so you get exposure to the overall performance of this company. And then, we'll qualitatively look at the output of the work that you do and figure out what other compensation adjustments need to be made over time based on that. But what we're not going to do is come up with some specific KPI that you're only and always optimizing for. And to the extent that there are KPIs like that, it's often a little bit more senior than the people who are actually doing the research and making the decisions, because you want the person who's measuring that performance indicator to be thinking about trade-offs and to be optimizing it over the term that makes sense, and not optimizing it over just, what is the best way to get the highest number this quarter, and then we'll worry about next quarter sometime next quarter. And then that actually extends, by the way, to other kinds of company relationships. And so, if you tell that story of, okay, think about the work that you do and think about how you get paid. And if you don't own your own company and you don't have a job where you're literally on commission, or you literally get paid a piece of the P&L that you generate, it's almost always the case that the amount of revenue that you generate for the company you work for is a vast multiple of the amount that you get paid. And that if you do something that generates an extra chunk of revenue for the company, you get very little of that back right away. So it does look like one of these labor versus capital disputes, where companies just have more negotiating leverage than their employees, and they earn their profits from that leverage. But also, companies do that to one another all the time. And you can actually, within the same business, you can look at how well some service providers monetize by looking at how measurable the impact of what they're doing is. So within ads, if you are helping a company do direct response advertising, and they know how much a new customer is worth, and you are optimizing for acquire that customer for less than the company pays you for that customer, you have a lot of room to monetize very heavily. You are basically getting paid for all the value you generate. Whereas if the mandate is more like, we want to be a recognizable brand in this space, it's just a whole lot harder to make that argument. Among other things, you end up with the semantic satiation problem of, everyone at the company recognizes their brand name. Everyone at the ad agency recognizes the brand name. And so everyone feels like this company is now completely ubiquitous, whether or not that's actually been achieved. So the value capture there is a bit lower, but it's not like brand advertising is not worth doing. And, companies have done it very well. And some of the most valuable companies out there have been built on a lot of brand advertising, as well as as well as actually having good products. So it's clearly worth doing. It's just very hard to set up some way to pay for performance within brand advertising. You can do things like surveys to look at name recognition for a brand, and there is plenty of that activity, but that kind of thing can also be gamed. If you just tell an advertiser, I want my company's name to be as famous as possible. I'd like us to be trending on Twitter. I would like everyone to know who we are. If that's literally the KPI, and you're paying someone a percentage of tweet, a set amount of money per tweet mentioning the company name, then obviously the best thing to do is do something completely outrageous that is attributable to that company, and then get everyone really mad. They'll all tweet about it, and then you get paid. So it is hard to come up with the right action guiding metrics. And sometimes it's easier to just come up with parameters for the inputs and say, this is these activities we think will lead to value creation in the future. We can't precisely measure that, but if you do that, you will get paid. And, we'll try to find some way to measure the difference between doing that and doing that well, so that we can also pay a premium for skill.
That makes sense. I want to segue to, you wrote a bit about Amazon. So maybe we could talk about first their fast delivery to remote areas expansion.
Yeah. So this was the Wall Street Journal had a fun piece on this, that Amazon is trying to extend their same-day and two-day delivery network into more remote places. They've done some clever things like partnering with local businesses, which it feels very, very old-timey that, every once in a while you go visit you ride into town and visit the general store, and you find out there's a package from the East Coast, and it's your family sending you something, but it's Amazon, and it's the thing you ordered the day before. But the other thing that I was thinking about there was, With logistics networks, you get this operating leverage because the more users your network has and the more delivery people your network has, the more of the time that you're paying for from both people and vehicles is time that's actually in use and revenue producing. So you want the network to be as dense as possible. And also, once you've built out that network, it's very expensive and very redundant for someone else to build one out too. So combine those two things. And if you are Amazon, you have very good models of how customer ordering behavior responds over different periods of time to the ability to get things 2 days after ordering them or 1 day after ordering them. So you actually have a pretty good idea of how ordering behavior is going to evolve over time. You probably also, if you're Amazon, have some sense of things like if there is an increase in the number of packages that have the Amazon logo that are on this person's front porch, what does that do to their neighbor's propensity to spend on Amazon regularly? I'm sure there's a reason that Amazon bothers to put their logo on everything and to put ads in all their boxes. And it's probably because they've run the numbers, and whatever that cost is, it's more than paid for by the lift in orders. But if you put all those together, and the right time to invest in a logistics network is probably before it's profitable. You probably want to have trucks on the road that are not producing a positive contribution margin for your business, but are ensuring that next year, when like for like orders from that cohort of users is up 10% because they're all taking advantage of 2-day shipping, that now you flip to slightly positive P&L, and then every incremental increase in number of customers and orders per customer is just adding points to your margin. And at no point is it worth it for someone else to replicate that part of the network. So you end up with a little monopoly. It's annoying to get a monopoly on like the structurally most irritating and least profitable part of free first and second day delivery, which is doing it in really remote locations that only barely justified economically. But you do get some kind of monopoly there, and that does give you some long-term pricing power. And then the other question for Amazon is always, they are generating lots of cash flow. They used to have lots of things to dump that cash flow into. There are fewer things that can absorb huge amounts of capital and get decent returns. So they're always looking for that kind of investment where they scale it a little bit to test it, and they've confirmed that they can dump another few $1 billion into this and still get decent returns over time.
Amazon was famously controversial early in its history for not producing a lot of profits, right? For continuously reinvesting. Can you explain exactly what that was? And looking back, was that obviously the smart strategy, or how do we make sense of that? Should more companies be doing that?
Yeah. So one of the best things to read on this is Eugene Wei's. He has a really good series of blog posts about working at Amazon and how he thought. And in one of them, I think it's called Remove the Legend to Become One. And it is ostensibly a piece about why Excel's default charts are not very useful and what you should do differently. But it's also a piece about how Amazon thought internally, how they developed their quarterly business review process. And one of the things he mentions kind of offhand in that piece is that he was at Amazon in the late 90s. So he was involved in this quarterly review process of all of Amazon's business. And that doing that convinced him that Amazon was on the right track because he was looking at their cohort level economics. So you land a user in 1997, they spend, $30. You spent $200 to acquire that user, and it costs you $28.50 to fulfill that order. So things are looking pretty bad if they're at that continued level of usage. But maybe next year they're spending $100, and the year after that they're spending $150, and it just keeps on growing. And you start to realize that, hey, our contribution margins on a user level are going up as we scale, and users keep on spending more money. And so the present value of the users we've acquired is actually far in excess of the cost of acquiring them. And you combine that with capital markets that were very generous to Amazon early on, including letting Amazon issue lots of convertible bonds. And you have this recipe for maximum speed growth and just trying to funnel money into acquiring customers and building up fulfillment centers as quickly as possible. And then there's this amazing period in early Amazon history in the early 2000s when the music stopped in the stock market. It was no longer possible for Amazon to just keep issuing stock and keep issuing bonds to meet their capital needs. So they had to drastically curtail growth. And I think they got to the point where there was some quarter in 2001 or two where I think their year-over-year growth was basically zero. Like Amazon had shifted from we double our revenue and we double our losses every year, and the revenue number and the loss number not too far apart, to Amazon does not grow anymore. But the reason for that was that a lot of those expenses were expenses underwritten on the assumption that Amazon would keep raising money. And You can go back and forth on that. I think one view of this was Amazon did burn a lot of capital in the period between when the tech stock market started going down in March of 2000 and when they actually finished killing off all of these growth projects. And then the other version is no, actually, Amazon did this quite optimally, that if you can acquire customers who are worth multiples of what it costs to acquire them, and if the market is willing to underwrite that, you should do that as quickly as possible for as long as the market is letting you do that. And then once the market's not letting you do that, like always have a contingency plan, always know which fulfillment center development you're canceling first and which ad campaign gets the axe first, et cetera. And know how your launch cadence is going to stretch out as you have less resources to devote to everything. But also, once you've done that, once you know that you can survive without raising that next round of capital, then you do want to just keep raising capital and just keep on growing. So I think that strategy was I guess it was sort of embraced but not understood by public market investors in the late 90s. Like, they could definitely see the growth rates, they could feel this revolutionary thing happening, and they were betting on a company with a charismatic founder and a good story. And then there's this period in the 2000s where you can read lots of public comments from people saying that Amazon just doesn't make sense, that it's being subsidized by Wall Street and that it can't really make money. There were times when Amazon would just slow down their growth and operating expenses for a quarter or two, demonstrate that they were actually perfectly capable of running a profitable business. They were just choosing not to. And then they would go back to closer to break even. So I think for a while it was just kind of this dated assumption where it was after a while really hard to justify. And now Amazon almost has the opposite problem of they are generating lots of cash and there is a finite list of things they can invest in. And they've always tried to make the early investments that allow them to dump a lot of money to something later on. But you never know which thing will actually scale. And there's also the question, and I think Alexa is probably an example of this, where yes, they did find a product where they can dump lots of money into it and they do scale units sold, but they don't actually get to the point where there are positive contribution margins. Although even that is somewhat opaque. There are lots of attribution questions. There's actually a journal article on this recently that part of what drove Alexa's growth and what got them a lot of internal capital allocated was they were getting a lot of credit for hypothetical future orders that people would make on Amazon using their Alexa devices. And apparently that assumption was not being dynamically updated based on the actual behavior of actual Amazon users. We actually had Alexa for the kids for a while, and then I don't exactly remember why they no longer have Alexa. I think it was a temporary punishment we just forgot about, but it was mostly used as an alarm clock and, for listening to podcasts and things. It was not actually driving a whole lot of incremental revenue for Amazon. So that was a case where, yeah, I'm glad that Amazon subsidized this because it was a good consumer experience while it lasted. But in general, Amazon tends to be pretty hard-headed about these things. They will subsidize things for a while, but they subsidize things in order to reap the profits later on.
You also alluded to sort of a culture drift happening at Amazon, or you point to an article there. You're still long Amazon, I believe. Is that in spite of what's happening in the culture? They're just such a solid business in the Warren Buffett sense?
Yeah, the culture drift thing. So there's an article in Fortune about just Amazon transitioning to a new CEO and how that just changes norms. And I think there's a meta point here, which is that a lot of companies that are built by a founder, and that founder ends up setting up an org chart that meets their particular needs. And so if you have someone who's just really, really good at absorbing a large volume of information, zeroing in on the handful of important problems, and just working relentlessly to solve those problems, then you end up with a certain org chart and certain communications norms. And if you find someone who's still somewhere in the 99th percentile on those traits, but is 5% less good at managing all those little details, suddenly they always have slightly more information than they can actually handle, and you just need to reformat a lot of different communications to deal with that. You can sort of view GE in the post-Jack Welch era as a kind of pathological version of that, where Welch was really good at knowing the details of what GE was doing, but he was also really good at knowing details of how the accounting could look slightly better. Here's, this random subsidiary happens to own an office building that they bought 30 years ago. It's appreciated a lot. So if we are half a penny short on our earnings this quarter, might as well sell the building, lease it back, and we'll hit our number. But then, in the post-Welch period, there were just slightly more balls to juggle than the next juggler could handle, and the whole thing fell apart, I guess, gradually than suddenly, as such things go. And is now looking a lot better. So sometimes companies go through a transition, cultural transition like that, and you've got to give them 20-something years for them to really get their footing again, but it does eventually happen. I don't think Amazon is running through that problem, but there is an issue. So the thing that worried me in the Fortune piece was PowerPoint, because PowerPoint is just not a very good tool for conveying complicated thoughts. It's not a very good tool for making plans. It is kind of a fun tool if you like getting in front of an audience and performing, but that's probably not something you want to select for in most organizations. And apparently PowerPoint is a little more common in Amazon than it used to be, although memos are still the main means of communication. And it could be, and this is like the case with a lot of companies where they're kind of purist on the outside, and then on the inside they're a little bit more pragmatic, a little bit more nuanced. You hear about this with companies where they are in love with some particular programming language or some particular organizational structure or whatever, and then you find out, okay, that's like true, 70% of the time, which is a really big number, but it's not actually true 100% of the time. I think Amazon, it might be similar to that. Like, I'm sure it's not the case that there were literally no PowerPoints in Amazon until Andy Jassy took over. But if it is the case that Amazon is slowly converging on other companies' norms, it becomes a little bit harder to bet on them as just, one of the handful of really extraordinary companies. But also, those kinds of drifts can take a really, really long time. And I'm sure that there were people in 2004 who were also saying, the Amazon I knew and loved is over. Our culture is completely different from how it was when I joined. And perhaps they were right too, but you can have some tolerable level of cultural drift, some inevitable level of cultural drift, and you want to know basically where you are in that process. Like if you're looking for institutions that have successfully resisted that for a really long time, the sterling example is Hacker News, where anyone can sign up, anyone can post comments, and yet the culture has been remarkably consistent, and it is the result of their moderators spending a lot of time both just doing the manual work of deleting spam, deleting abusive comments, etc., but also the work of writing responses to people, telling them this is actually not how we do things here, and here's a write-up on more, and here's what you should do if you don't want to get banned. So it is just a labor-intensive thing to maintain that cultural cohesion. And in some institutions, the ability to do that does actually lead people to power trip. And you also don't want an organization where you can invert the org chart if you are better at quoting things that the founder wrote in a memo 10 years ago than the person you're arguing with. So even there, you need some level of balance.
You wrote the other day about sort of the one model or many topic. How should we think about, whether there'll be countless specialized AI models or so, more consolidation, or what's sort of the right point of the spectrum, how to think about this?
Yeah. So what I ended up kind of talking myself into is the view that it'll be both. And that the way it will work is that most people will default to one main AI model that they interact with that has some kind of agency. You may still have the format of a chatbot. Maybe you're talking to the chatbot instead of typing to it, but you're still interacting with one model. But then the work that model does will probably end up using numerous third-party models that are specialized in very narrow domains, because there are a number of domains, probably a large number of domains, where past a certain point, you care more about data quality than data quantity. And where by pruning the training data to just the highest quality sources, you actually get better results than if you added more sources. So law might be a really good example. Like if you have a choice between a lawyer bot that's trained entirely on legal textbooks and law rulings and things like that versus another legal bot that has all of that, but also every discussion that's ever happened on Reddit in which someone claimed to know that something was definitely legal or definitely illegal. Probably that second bot, like it has a lot more training data, probably in terms of just producing human language, it's better. But in terms of producing legally accurate language, it's not so good. And also in some of those domains, the actual facts on the ground are changing all the time. So if your model doesn't really have a sense of temporality, if 2024 is just another token, then it is a little bit harder for it to do things that involve time series and do things that involve, what you would have known at this time that you don't know today. Like that kind of thing infects a lot of models. So if you ever ask ChatGPT what the median American adult would have thought about some contentious issue at some point in the past, ChatGPT is very, very bad at replicating that. It's very, very good at saying, what someone today would say if they held those views at that time, but it's pretty bad at actually replicating those views. And that even like that dynamic of a year is just a token, it actually shows up in other places too. So when the New York Times had their legal complaint against OpenAI for scraping them, one of the things that the Times was able to do was, through a lot of prompt engineering, they were able to get ChatGPT to produce a couple paragraphs at a time a long article that the New York Times had written about Uber drivers. And as OpenAI's lawyers pointed out, one reason that was true was that there were a handful of New York Times articles that were widely quoted all over the internet, and that ended up just like many copies of that text showed up in different training corpuses. But the other interesting thing to me was if you looked at the OpenAI, like the ChatGPT recreation of the article line by line, there were cases where it didn't actually recreate the full text of the article, and it was often cases where a specific quantity, like amount of money that taxi drivers had borrowed against their medallions, like it did not actually reproduce that sentence. And that actually felt really, really human, because if you treat a number as a token, like numbers have connotations. 2001 means something. 1939 means something. 1929 means something. 1987, like all of these have immediate connotations. And if someone says this is just like year N, you know, if it is one of the correctly chosen years, you know what they mean. But a number like 330 million does not have any of that kind of connotation. And so like a person who is retelling a story but doesn't remember some of the quantitative details, you might just be tempted to skip over it, and the LLMs do too. As they get better at specializing, or as there are more specialized models, they may have, they may ask HistoryBot for the exact data, or they may learn to query a time series and pull the data that way. And so what you can end up with is that you're interacting with an agent. The agent is interacting with other models. Those models are getting paid by the company that operates your agent. You're paying that company either some usage-based fee or just a hefty monthly subscription. And in that case, it actually kind of replicates the OS versus application split of the PC era, where you're in a really, really good position if you control Windows, especially if you control Windows and you're building the business critical apps on Windows. It takes a lot of effort for someone to dislodge you. And I think all you have to do is like compare Internet Explorer to the various alternative browsers through most of the browser wars to know that owning the operating system is a really big advantage. And my suspicion is that those general purpose models will have a similar advantage, but also as with the software world, there is plenty of room to make money if you still have the best thing in a category. That category is valuable, and you know that there's going to have to be compatibility between the high level like interaction layer that every user has and then the specific application that you have.
Yeah, that makes sense as to reasons why there would be both. And we're just at time, so this is a perfect place to wrap. As always, a great overview of some of the topics you've been thinking about. And until next week.
Yes, indeed. Great chatting. See you next week.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Byrne's excellent newsletter, The Diff, if you haven't already.